It is the end of the year, which means it is time for tax planning. Way too many people don't think about taxes till after the year is over, and they leave so much on the table. I think I have to start this conversation just by saying, one, people don't do enough tax planning. There are so many wealthy people out there that just neglect their taxes. They have a tax team who files things after the year. They have nobody who proactively looks at things through the year. And this is a recipe for disaster. One of the most controllable financial planning moves that you can make is to control your taxes and your tax planning. Tax planning is not just a one-year thing, it's a lifetime thing. And so like on a yearly basis, how we think about it is in the beginning of the year, we wrap up prior year taxes. We let our clients know what they're going to owe come April. Then in the summer, we do their tax planning for this coming year. If their tax return's done, we review it, but most wealthy people don't have all of their documents, their K-1s, et cetera, so they can't get their taxes done till September, October. But we'll review their tax return if it's done, and then we're going to look at what are we projecting for profit? What are we expecting on salary? What are we expecting for RSUs to hit? All of the things that are going to happen throughout the year. And we take projections. So we know what we're going to pay quarterly if we're going for 110% safe harbor or 90% of current year. We know what tax planning moves we're going to make. Are we going to optimize QBID? Do we have tax loss harvesting? Are we going to do blah, 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 right? We use that year to game plan, or that time of the year to game plan and plan. And then at the end of the year, in October, November, December is when we wrap up projections and we finalize all the tax planning moves that we're going to make. What are those tax planning moves? The first one is just mapping out what you're actually going to make. For a while, for the whole year, you've kind of just been estimating where are we at. Now, towards the end of the year, we actually realize what it's going to be. First thing that we're going to do is we're going to look and say, okay, here's what we're expecting for income. What quarterly payments do we need to make? Most wealthy people have to make quarterly payments. It's just how it works. Almost all business owners do. So we're going to look and say, okay, great. Did we assume that you were going to do more than you ended up doing, and now we don't need to make a Q4 payment, or does our Q4 payment go down? If you're doing 110% and you're going to make more than the prior year, it's pretty easy. Make your Q4 payment, wrap up what you're going to owe come April. If you're going to make less than last year, we're needing to hit that 90% number. So we need to make sure through withholding, through quarterlies, we get you to that 90% number to avoid penalties. So I think it first and foremost starts with what are we projected to owe? What are we projected to make? What payments do we need to make? I think a lot of people think tax planning is only what do you do to reduce your taxes? But first and foremost, tax planning is about paying quarterlies and what are we going to owe. Then from there, we start to review all of the different tax planning moves that we can make. The first one that I think about is how much are we going to be able to put into our 401ks or solo 401ks. So if you're an employee, this is looking at your pay stub, right? Are we on track to max this out at 23.5 or 31? For some clients, if they're doing mega backdoor, this is a good time to look and say, am I overdoing the mega backdoor where I'm going to not end up maxing out my pre-tax side, or it's going to end up getting reducing some of the match because I can only get that 70,000 in. So that's one part. We're going to see, what do we have room in your solo 401k? Do we have wages to get you to the full 70? If not, how much are we going to do mega backdoor? If you are a partnership or a sole prop, we need to figure out profit first. If you're going to crush and have more than enough profit to get in the full 70, do it. If not, then you have to wait till taxes are kind of getting wrapped up to understand profit to figure out what you could put in. First and foremost, get the employee contribution done. That is due by the end of the year, especially if you have a salary. If you don't have a salary, your partnership or sole prop, you do have till tax filing deadline. So you have that lever to pull. And then the employer side for all parties have until the tax filing deadline. The next one to look at is HSA. Where are you at on your HSA? Are you going to max it out? If you're doing it through payroll, ideally you just max it out through payroll. The one thing to know is you don't have to do this by the end of the year. You can do this up until your tax filing deadline. But the issue is then it's like, okay, I've been doing it through payroll. I have another 1,000 to get in. Maybe you can't directly put money in outside of payroll. So you have to set up a new HSA. Now you have two separate HSAs. It can just become kind of annoying. So ideally, if you're doing it through payroll, do it by year end. If you're doing it outside of payroll because of better investments or because you're an S Corp owner or some other business owner, then you can do it till tax filing deadline. Next one to think about is 529 plans. If you live in a state with a deduction, you want to get your 529 plan funded. So in Indiana, if you put in $7,500, you get a 20% tax credit. If I don't get that in this this year, and the next year I want to do 15,000. Well, too bad. You only got the $7,500 benefit. You want to get that wrapped up before year end. For business owners, you want to look at the qualified business income deduction. So as a reminder, this is 20% of your profits until your AGI becomes too high, which is, just under $500,000, to then it becomes either you don't get the deduction if you're an SSTB, which is, lawyer, doctor, financial advisor, CPA, etc., or you get the lesser of 20% of profits or 50% of W-2 wages. So a lot of people will be profit heavy, which means, hey, okay, we need to pay out more, in bonuses to other people or bonuses to myself to reduce profit and get the salary to be optimized with the profit to maximize this deduction. That's a really big one. Some people are salary heavy. So that means you might want to defer bonuses till January of next year. It might mean you want to make sure you get the rest of your dollars out via distributions. Obviously, you need to make sure you have a good, reasonable wage. That's super important here. But you want to think about how do I have the right reasonable wage, but also maximizing the qualified business income deduction. At this time of the year is also where I have clients look at their entity election. Is this the right election for next year? Because ideally you get to move January 1 to the right structure. So maybe, you have been a sole prop and next year S Corp makes sense. Great. So, hey, we've talked about it. We plan what it looks like next year. Come in S Corp in Q1. Maybe you're sole prop and you should be a partnership. You've really built up this business and, we need to be able to elect into PTET next year. We can think about that. We have a bunch of business owners who, with the new QSBS eligibility, we need to think about restructuring a Type F reorg or something along those lines to move to C Corp because now they're building out software-based companies. So reviewing your entity structure, making sure it's correct at the end of the year for the next year is something that I always advise my clients to do. Those are some good ones. Other ones to think about, just on the, business owner side of things are accelerating income. Should we take more income this year because we think next year is going to be a higher tax year? Should we think about accelerating certain expenses? We could think about, should we switch from cash to accrual basis? Maybe moving to accrual will be better for our business in the future. Those are some good ones to think about at year end. Obviously, earlier I talked about making sure you pay the right amount of taxes. So for the S Corp owners, maybe we realize that we haven't paid enough for quarterlies throughout the year. So when you run your bonus, you can withhold a lot for taxes, and then it basically will go back for Q1, Q2, Q3, Q4, and help insulate you from penalties. We work with some people who pay $100,000, $200,000, $300,000 in a year-end salary every year, and we just square up withholding to get them into a good spot because every year is super volatile and they just don't know what the year is going to look like, and they use the end of the year to wrap all that up. Some other things that you could think about, we want to make sure you use your dependent care FSA funds. You want to use your regular FSA funds for health expenses. Know how much you can roll forward versus how much is use it or lose it. We could think about end of year tax loss harvesting, right? So do we have any short-term losses? Do we have long-term losses? Taking them in this year is helpful because not everybody knows this, but you can use losses to offset gains this year. Any amount left over offsets $3,000 of income, and then anything left over gets carried forward to the future year and kind of stays on your tax return until they all get used. So tax loss harvesting makes a lot of sense. Maybe we're tax gain harvesting. Maybe we've realized we have a bunch of losses to use. We have positions we want to trim out of. We can do that without paying any taxes. Great, let's sell. Let's move to something else. The big one is Roth conversions. There's a lot of people who think about Roth conversions. Roth conversions is all about, paying the tax and moving money from pre-tax to Roth at advantageous periods of time. This can be either when the market's down. This can be when we're in a low bracket. Ideally, it's a combination of the two, or at least when we're in lower brackets. Just because the market's down doesn't mean you want to pay 35 or 37% tax. So for most of our clients, we estimate where they're going to add income wise. We say, here's how much we're going to do Roth conversion wise. And at the very end of the year is when we make the decision, right? Do we actually have that room? What amount room is there? Is this the right time to do the Roth conversion, getting it done, not withholding the taxes, and then knowing, hey, here's the tax impact that makes. Maybe if you're doing 90% safe harbor, that means you have to make a higher Q4 payment. Maybe it just means that you have to plan for your tax liability due in April, but end of year is a really good time to be doing Roth conversions. Another one to think about is charity. One thing that a lot of people don't know is charity changes next year. So next year, the first 0.5% of your AGI is no longer deductible. If you make $100,000, that's the first $500. It doesn't really matter much. But a lot of my clients make $2, $3, $5, $7, $10 million. So if you make $5 million, basically the first $20,000 of charitable giving you don't benefit from. So a lot of our clients, we're pushing them to front load charity in this year. Because if you think about the next 5 years, if you give up $20K of charity per year as a deduction, that's $100,000 deduction that you gave up, 37% tax rate, maybe state, that's $37,000 to $50,000 of tax savings they're giving up. So what we're doing at year end is we're front loading this. We have a donor advised fund. We're donating appreciated security. We're getting to avoid the capital gains. If we want to use the cash to buy it back, we can do that, or we can use it to diversify. But end of year time is the time to think about charity. If you're in a higher income year, higher income bracket, doing that. But on top of that, the most important thing is understanding this new 0.5% AGI rule, which is pushing a lot of high earners to donate more to charity this year. I would say the only other thing that I would think about here is potentially PTET. So for a lot of clients who are in really high brackets this year, maybe they'll be in a lower bracket next year, thinking about paying that last PTET payment a little bit earlier. Do they have the ability to deduct those state taxes in this year? Because it's based on when they're paid. I think that's probably all the tax planning moves that I want to get across, but I want to iterate beginning of the year, think about taxes, game plan for it, end of the year, wrap up, what's everything looking like, what planning moves do we want to make, and it's all about actually getting these done. A lot of people think about it, and then at the end of the year, they're busy, and then the year ends, and they're like, oh gosh, what tax plan can I do? I see my tax liability, but at that point, it's over. You've given up most of the tax planning moves. Some of the things you can still do, like I talked about, is HSA. You can still do your backdoor Roths or regular Roth IRA contributions. You could still do cash balance plans. So that's, I guess, one thing I didn't talk about. So, cash balance plan and profit share. So if you have a 401k post year end, you can do a profit share for you and your employees, either equal for everybody or proportionate to income. And you can also set up a cash balance plan, which allows you to defer a lot more as well. So that's something to think about. And then the only other thing I know I didn't talk about is just annual gifting. So, hey, at year end, we're in a really good financial spot. We want to give, me and my spouse want to give $19K to each of our kids to get money and move it out of our estate without using any exemption. That's probably the last year end thing that you want to think about. So everybody, appreciate you listening. Use this time, plan for your year end taxes. Again, it's one of the most controllable parts of your financial life. Use the tax code, game plan. If you're a really high income earner, you're a business owner, you have so much room for tax planning. Take advantage of it. Thank you for watching. If you enjoyed this video, please leave a like and go follow my page for more personal finance content. And as always, if you have any thoughts, please leave it in the comments below, and I promise to get back to each individual comment. See you next week.